At some point in modern history, money stopped telling the truth. For most of human history, money had limits. The shift began long before most people think. In 1694, the Bank of England was founded not to stabilize the economy, but to finance war. The government needed money it didn't have. The solution wasn't higher taxes, it was debt. Banks began lending money that didn't fully exist, backed by future tax revenue. This was revolutionary, then dangerous. Fractional reserve banking followed. Banks realized they didn't need to keep all depositors' money on hand, only enough to meet withdrawals. The rest could be lent out. Money was no longer just stored value, it was manufactured through confidence. As long as people believed the system worked, it did. This model spread across Europe, then the world. Each step loosened the connection between money and reality. Gold, silver, grain, receipts money was tied to something tangible. Couldn't create it at will. You had to find it, mine it, grow it, or earn it. That scarcity imposed discipline on governments and banks alike. Even early paper money was merely a claim on something real, stored somewhere else. But that system had a flaw from the perspective of power. Scarcity limits spending. And governments, especially during wars and crises, don't like limits. The temptation was always there. What if money could be stretched? What if promises could circulate as if they were value itself? That question would change everything. Not all at once, not with a single announcement, but quietly, so quietly that most people never noticed. Today, money no longer represents stored labor, scarce resources, or real economic value. It represents policy decisions, votes, emergency measures, confidence narratives, targets set by committees behind closed doors. And here's the unsettling mystery. If money is no longer real in the traditional sense, if it's created, destroyed, redirected, and redefined by policy, then what exactly are we working for? This is the story of how money transformed from a reflection of reality into a tool of control, and why every financial crisis since has followed the same script. Fast forward to the 20th century. World War I forced governments to abandon gold standards temporarily. After the war, they tried to return, but the damage was done. Debt levels were too high. Gold constraints were inconvenient. Then came the Great Depression. Instead of questioning the debt-based system, policymakers concluded the problem was not enough control. The solution? Central banks with broader powers? In 1944, the Bretton Woods system attempted a compromise. Currencies tied to the dollar, and the dollar tied to gold. But this too was fragile. By the 1960s, the U.S. was running massive deficits: Vietnam War, social programs, global military presence. Foreign governments began asking for gold instead of dollars. There wasn't enough gold. So in 1971, President Nixon closed the gold window. No gold, no backing, no anchor. For the first time in history, all major global currencies were pure policy instruments. Money was no longer constrained by nature, only by political will. From that moment on, money didn't reflect reality, managed perceptions of reality. Interest rates became tools to stimulate or slow behavior. Inflation targets replaced price stability. Asset prices became policy objectives. When bubbles formed, they weren't allowed to fully burst. When debt grew, it was managed. Each crisis followed the same logic. The system breaks, central banks intervene, more money is created, structural problems are postponed, this worked temporarily. But each intervention required more intervention later. Debt stopped being a warning sign. It became the engine. By the early 2000s, economies weren't growing through productivity, but through leverage. Money wasn't measuring economic health, it was masking decline. The 2008 financial crisis exposed everything. Banks created trillions in credit. When it collapsed, central banks didn't let the system reset. They injected unprecedented liquidity. Quantitative easing wasn't temporary, it became permanent. By 2020, during the pandemic, money creation went exponential. Trillions appeared with keystrokes. And here's the key consequence. When money becomes policy, inequality explodes. Why? Because new money doesn't enter the economy evenly. It flows into assets, first stocks, real estate, bonds. Those who own assets get richer. Those who rely on wages fall behind. Inflation isn't a mystery, it's a side effect. Money lost its role as a neutral medium. It became a redistribution mechanism, quietly, invisibly. Each proposed fix follows the same flawed logic. More regulation, more stimulus, more debt. More confidence messaging, but none address the core problem. Money is no longer grounded in reality. You can't fix a measurement tool that no longer measures. Raising rates causes debt crises. Lowering rates fuels bubbles. Printing money delays collapse but accelerates decay. The system is trapped. Policymakers aren't T-evil, but they reconstrain by a system that can T-survive truth, so they manage narratives instead. Look around. Record global debt. Asset prices detached from incomes. Central banks reversing policies overnight. Currencies losing purchasing power while markets rise. The same pattern repeats across history. Rome debased its currency. Weimar printed money. Modern economies. Digitalize inflation. Different tools. Same outcome. Money stops reflecting reality. Society loses trust. Systems strain. The difference today? This is global and synchronized. There's no external reset. Takeaway 1. Money is no longer a store of value, it's a policy signal. Takeaway 2. Debt isn't a bug in the system. It is the system. Takeaway 3. When money stops telling the truth, individuals must learn to read beyond it. The warning is simple. A system built on confidence alone requires constant belief, and belief eventually breaks. The open question isn't if money will change again. It's who will be prepared when it does. If this video helped you see the system differently, subscribe, because understanding the rules is the first step to not being trapped by them. And remember, when money becomes policy, reality always sends the bill.